Okay, let's unpack this. There's a really fascinating conversation happening right now about Latin America. We're seeing everything from surging investment opportunities to these deep discussions about economic integration and, well, the social impact too. So today, our mission is to take a deep dive. We've got a stack of diverse sources here, financial reports, academic journals, the whole lot. We want to uncover exactly why Latin America is making such big headlines, what's it mean for global markets, and what are the intricate social dynamics really at play. The goal is simple: give you a clear, comprehensive understanding, but without all the information overload.
Yeah, and what's truly interesting here, I think, is how you've got these multiple threads just weaving together. You have economic resilience, this evolving market integration picture, and then the absolutely crucial element of social equity. They're all defining the region's current path. So we'll try and connect those dots for you, help you grasp not just what's happening, but the sort of deeper why behind it all.
Okay, perfect. So let's jump right in. The big question: why now? Our sources are throwing around phrases like optimal destination for investors for Latin America in 2024. Where's that optimism actually coming from?
Well, it's definitely rooted in some pretty compelling data. If you look at the International Monetary Fund, the IMF, they've highlighted a stronger than expected recovery from the pandemic and, continued resilience right through 2023.
Stronger than expected. Interesting. Yeah.
Exactly. And their GDP growth projections for Latin America and the Caribbean, they're looking at 2.3% for both 2023 and 2024. Now, that's not just a number, it kind of signals this surprising reversal where Latin America is actually outpacing the advanced economies.
Right, which were projected lower, wasn't it? Around 1.5%.
Yeah, 1.5% and 1.4% respectively. So a noticeable difference. And then there's inflation.
Hmm.
Across the region now, if we exclude Argentina and Venezuela, that's important. It's
Yeah.
expected to drop to 5% in 2023. That's down significantly from 7.8% in 2022.
Okay, so growth up, inflation down.
Pretty much. And just to add, as of May 2024, the IMF even shared a positive outlook on Argentina's progress. They seem to be making headway on restoring macroeconomic stability.
That's definitely a powerful signal of resilience. And this optimism, it's being amplified, isn't it, by the global lower interest rates?
Yeah.
Is that creating space for new market entries?
Absolutely. That's creating fertile ground. Particularly, we're seeing it in Brazil. Economists are estimating at least 19 Brazilian companies are set to launch IPOs, initial public offerings, in 2024.
Wow, after a bit of a drought, right?
Exactly. It's ending a 2-year drought. And we're talking about sectors like fintech, real estate, energy, infrastructure, all sort of lining up to join the market.
So Brazil seems like a key story here.
Brazil's economic advancements really do stand out. I mean, in 2023, it officially became the world's ninth largest economy, GDP of $2.13 trillion, dollars,
Hmm.
and the projection is it climbs to eighth place by 2026.
Eighth largest, okay.
And internally, a really crucial development was this big tax reform approved in December 2023. It basically merges 5 different taxes into just 2 value-added taxes, 2 VATs.
Simplifying things, presumably.
Hugely. Specialists believe this simplification will make investing in Brazil cheaper, make its products more competitive globally. Some economists are even projecting, get this, that this single reform could lift Brazil's potential GDP by something like 12% to 20% over the next 15 years.
That's a really significant projection for Brazil. But are there any counter arguments, any dissenting views on this tax reform, or maybe potential pitfalls that could derail such an optimistic outlook?
Well, the sources do acknowledge that any large-scale reform like this always comes with implementation challenges. You need to balance interests carefully. But the general consensus seems overwhelmingly positive, especially given the sort of strong political will behind it. And that actually brings us neatly to investor sentiment, which, as you hinted, has shifted dramatically towards Brazil. Remember, there was some initial wariness, maybe skepticism about President Lula's third term, concerns about past fiscal issues.
I do remember that, yeah.
But check this out. A poll of fund managers in August 2023 showed unfavorable views just plummeted from 90% back in March down to just 44%.
Quite a turnaround.
Massive turnaround. And you couple that with inflation dropping sharply, it was 12% in April 2022, down to 3.2% by August 2023. Plus, S&P Global Ratings elevated Brazil's credit rating in December 2023. So it all starts to make sense why Brazil became the world's third largest FDI recipient among OECD economies in 2022, and then climbed to second largest in 2023.
Right. So zooming out a bit then, beyond just Brazil, what's making the whole Latin American region look more stable, more appealing right now?
I think a big part of it is relative stability. Compared to other developing areas, you look at instability in parts of Europe, the Middle East, Africa, Asia, Latin America is increasingly seen as, well, relatively stable.
And that plays into global trends.
Directly. It feeds right into this friend-shoring or ally-shoring trend. Companies are strategically looking to relocate supply chains, investments to countries that are politically aligned or just geographically less risky, more reliable.
And Latin America benefits.
Clearly. Plus, just looking at the markets themselves, stock prices are generally lower and dividend yields are higher in the region. That's attractive for foreign direct investment, for asset allocation. Mexico alone, for instance, pulled in $21.4 billion in FDI just in the first quarter of 2025. That's up 5.4% year over year.
Wow. And U.S. investment is big there.
Huge. U.S. firms accounted for nearly 39% of that flow into Mexico. And then, of course, you can't forget the region's just immense natural resource wealth.
Gold, silver, copper.
Exactly. Gold, silver, copper, vast agricultural products, hydropower. And alongside that, significant new greenfield investments popping up, especially in critical areas like energy, hydrogen, lithium, mining. Argentina and Brazil in particular saw a lot of that in 2024.
Okay, so it sounds like there's this really strong undercurrent of economic strength potential. But what happens when things get rough globally? Like that bumpy patch the markets hit recently, April 2025. How did Latin America hold up then?
Right, that was a real test. You had sharp declines in Asian and European stock exchanges, a lot of volatility on Wall Street, driven by U.S. trade war fears, recession talk. But Latin American markets, interestingly, showed notable signs of resilience.
Resilience, okay. Even with tariffs involved, I remember reading about Liberation Day tariffs.
Yeah, most major economies in the region did face a 10% base global tariff on that day, but the impact actually seemed relatively limited or indirect. Certainly outside of Mexico, it showed a kind of surprising ability to weather those external shocks.
Okay, let's drill down into that. How did specific countries navigate that turbulence? What was the story for, say, Brazil?
So in Brazil, its main stock index, the Bovespa, it was down 1.31%. The dollar did strengthen against the real, but local experts, interestingly, were suggesting Brazil might actually suffer less than developed economies.
Why was that?
Mostly because of its inherently high interest rates. They felt it provided a buffer. The recommendation was more like tactical risk reduction, but be ready to jump back in. So its domestic policy levers seemed quite effective.
Okay. And Mexico. Given its close ties to the U.S., you'd expect a bigger hit there, maybe?
Well, Mexico definitely felt it. The peso was affected as value against the dollar rose, hitting 20.84 per dollar, which, is a big shift from 16.00 last year.
That's significant, though not the pandemic peak, right?
No, not the peak of 25.13, but still notable. Mexico's main stock index, the S&P BMV IPC, dropped 1.93%. But here's the thing. While there's political turbulence, U.S. tariff concerns. A lot of analysts felt much of this was already priced in. The market was trading at decade lows.
So maybe some resilience baked in already.
Perhaps. And you see interesting examples like Gruma, big tortilla maker. 72% of its revenue comes from outside Mexico in U.S. dollars. That shields it pretty effectively from tariffs impacting the peso.
That's a fascinating point about diversification. Okay,
Right.
What about further south? Chile? Peru?
Right, so Chile, its main index, the S&P IPSA, lost 3.36%. The dollar appreciated nearly 1% there. Now, copper, which is obviously huge for Chile, was excluded from those tariffs. But they still expect indirect effects. Their main trading partners slowing down impacts exports, consumption, investment.
Makes sense. And Peru?
Peru, its S&P Lima General Index fell 1.13%. Dollar rose about 1.03%. But interestingly, there's a Peruvian gold and copper miner, Buenaventura. It's shown strong operational performance, even upgraded its guidance. Its share price suffered a bit, but that was apparently due to local pension funds selling off assets, not fundamentals. So copper and gold are still seen as attractive there, highlighting that resource space value.
Okay, and just to round out the picture, what about Colombia, Argentina, Uruguay?
In Colombia, the Colcap index dropped 0.67%, and the U.S. dollar climbed 2.45% against their peso. Now, Argentina and Uruguay, they were both subject to that 10% base tariff. Argentina's main index, the Merval, fell quite sharply, 3.88%. And significantly, those parallel exchange rates, the dollar blue and dollar MAP, they jumped.
which signals anxiety, right, about currency stability.
Exactly. Underlying market anxiety is definitely surfaced there. And Uruguay's currency depreciated by about 1%.
So, okay, we've gone through a lot of specific numbers, country by country stories there. What's the simplest way, maybe to summarize how Latin American markets generally did during that global storm? And what does it tell us about their unique characteristics?
Well, I think what these individual movements really reveal is a kind of nuanced resilience. Yes, many indices declined, but the impact wasn't uniform, and it wasn't catastrophic everywhere. It really backs up this idea from our sources that emerging markets in Latin America are not just more of the same.
How so? What makes them different?
A few key things. First, they offer less geographically concentrated revenue streams compared to, say, EM Asia, which is super reliant on China. Second, the sector composition is distinct. You find much less IT and a more balanced mix with materials, consumer staple sectors often underrepresented elsewhere like EM Asia or EMEA.
So different sector strengths in different countries.
Precisely. Brazil is strong in financials and energy. Mexico leans towards consumer staples and materials. Chile, its financials, materials, consumer discretionary. That mix gives you better sector risk diversification.
Okay, diversification. What else?
There are unique thematic exposures too. Think about Brazil's huge exposure to efficient energy, 90% of its electricity from hydro and solar. Or its booming fintech scene with digital banks. Or Chile, second largest lithium exporter globally, heavily tied to the future of mobility, electric vehicles. These offer growth opportunities that aren't necessarily correlated with global giants.
Less correlated growth. Got it. And valuations. You mentioned those earlier.
Right, valuations. This is crucial. Latin America EM equities are currently trading at significant discounts compared to EM Asia and also compared to their own historical ranges over the last 15 years or so. Brazil, in particular, shows the steepest discount. This strongly suggests potential for what's called mean reversion.
Mean reversion, the idea that prices tend to move back towards their historical average.
Exactly. These potentially undervalued assets are perhaps likely to gravitate back towards their average values over time. That implies significant potential upside for investors who get in now.
Okay, so beyond the immediate investment angles and that market resilience, let's shift gears a bit. It's worth exploring how the region is trying to integrate its markets more deeply. What does that mean for investors, but also, critically, for the average person living there?
Yeah, that's a really important layer. A key initiative to look at is the Latin American Integrated Market, or MILO. It launched back in May 2011. The idea was to virtually integrate the stock markets of Chile, Colombia, and Peru. Mexico joined in 2014.
And others are interested too, right?
That's right. Panama, Brazil, Uruguay have all shown interest. The goal was pretty ambitious: create economies of scale, make transactions easier, boost diversification, lower risk, increase liquidity across these markets. A big vision.
Sounds good in theory. How's it worked out in practice?
Well, the initial findings, looking at data from 2008 to 2013, so this was even before Mexico fully joined, showed pretty mixed results. There was only a marginal impact on profitability, risk, correlation between the markets, and surprisingly, actually a negative impact on the amount traded and the number of operations.
Negative. That's counterintuitive.
It is, and it really underscores that market integration is a long, complex process. It doesn't happen overnight. You still have major hurdles like different tax treatments in each country, different ways assets are grouped in indexes. These things hinder full, seamless integration.
Okay, so the market integration part is maybe a work in progress, facing challenges. What about the social dimension then? Because Latin America, as we know, struggles with persistent challenges: income inequality,
Yeah.
economic disparities, limited social mobility.
Absolutely. It is statistically the most unequal region globally. You see Gini coefficients, that's a measure of inequality ranging from 0.38 to 0.53 across the countries. It's a stark reality.
And theoretically, things like regional trade agreements, RTAs, they're supposed to help, right? Create jobs, make goods cheaper.
That's the theory, yes. And sometimes you do see positive impacts, like Mexico's manufacturing industry under NAFTA did see increased employment and wages, helped build a middle class to some extent. But that's not the whole picture.
Right, so what's the other side of the coin?
Well, studies have detailed some significant negative impacts of RTAs on inequality, unfortunately. Particularly South-South RTAs agreements between developing countries, they can sometimes lead to trade diversion, making inequality worse, especially if they maintain high tariffs against outside countries.
How does that happen?
Often, trade liberalization removes protections for sectors that employ lots of unskilled labor, like farming or textiles. This can push down wages for those workers and widen the inequality gap. Chile's liberalization, for example, led to a documented increase in wage inequality.
And NAFTA in Mexico, you mentioned manufacturing gains, but wasn't there a downside for agriculture?
A big one. NAFTA's impact on Mexican agriculture is a really stark example. Small farmers just couldn't compete with larger, often heavily subsidized U.S. agribusiness. This led directly to increased rural poverty and fueled migration. It really highlights how these agreements, if they aren't paired with strong social safety nets or support policies, can inadvertently leave vulnerable communities much worse off.
That really brings the human cost into focus.
Yeah.
And this struggle, the small farmers,
Mm.
it kind of echoes the broader history, doesn't it? Neoliberal policies, agreements like Mercosur, the Washington Consensus back in the 80s pushing market reforms, deregulation, privatization. In Chile, Venezuela, Peru, Argentina, how did that play out for inequality?
Those reforms, yeah, they initially had pretty mixed results distributionally. Often they included rising inequality, wealth tended to concentrate, and there were often cuts in social spending at the same time. And then you have Mercosur, the Southern Cone Common Market set up in 91. The goal was regional integration, and while it did bring some economic growth, it also created inequities.
How so with Mercosur?
Brazil and Argentina, being the larger economies, tended to consolidate power and economic advantage. This made it harder for smaller members like Paraguay and Uruguay to compete effectively within the bloc. And crucially, Mercosur's big shift towards free trade wasn't really accompanied by the kind of social policies needed to help people or regions displaced by those economic shifts.
Unlike Europe, perhaps.
Exactly. Unlike early European integration efforts, which specifically included funds and programs designed to cushion the blow and support retraining or relocation, that social dimension was largely missing in Mercosur's initial design.
This really seems to pinpoint the core problem, doesn't it? It highlights this multifaceted responsibility involving different players.
Absolutely. It puts the onus squarely on governments and international organizations to really prioritize social policies. They need to actively counteract negative market forces and ensure the benefits of trade are shared more equitably. Then there's the private sector. Multinational corporations, they've often benefited hugely from these agreements, but there's also, let's be frank, a history of extractive practices in some cases, leading to environmental damage, human rights issues.
You mentioned examples earlier, like in Colombia or Brazil.
Right, places like Magdalena Medio in Colombia or issues surrounding the Amazon fires in Brazil. This clearly calls for stronger regulatory frameworks, much better accountability. And finally, you have marginalized populations, indigenous communities, small farmers. They're often the most vulnerable. They desperately need robust mechanisms so they can actually participate in the decision-making that affects their lives.
So it raises a really critical question then. What are the risks if these disparities are just ignored, if we don't address them?
The risks are huge. Indifference can rapidly erode the social fabric. It hinders genuinely inclusive growth. You can't have sustainable growth if large parts of the population are left behind. It reduces overall economic competitiveness in the long run. And ultimately, it means squandering geopolitical opportunities on the global stage. You lose that potential.
Okay, so acknowledging all these complexities, the social costs, the integration challenges, what are the solutions being discussed? How can Latin America foster more inclusive growth going forward?
Well, our sources lay out sort of three main policy options when it comes to future trade agreements. First, you could aim for inclusive multilateral trade agreements. These would have a really broad scope,
Maybe.
meaning they'd address the traditional trade stuff, tariffs, quotas, but also build in crucial elements like labor standards, environmental protection, intellectual property rights. The goal is equitable outcomes through a collective effort.
What are the challenges there?
Well, they're inherently complex to negotiate. And you're fighting against current global protectionist sentiments. But the potential payoff is big. Rebalancing trade gains, mitigating those negative social impacts we talked about.
Okay, that's option one. What's the second?
Second option is bilateral trade agreements with social clauses. These are more limited, more tailored. Two countries negotiating directly, they can specifically integrate labor and environmental standards. The U.S.-Jordan Free Trade Agreement is often cited as an example.
Downsides.
The risks include trade diversion, favoring the bilateral partner over more efficient global producers, and potentially fragmenting the global trading system into lots of separate deals.
Right, the spaghetti bowl effect, sometimes called.
Mhm.
Okay, and the third option?
Third is preferential trade agreements with a development focus. This approach explicitly puts economic development and poverty alleviation front and center. It uses tools like reducing tariffs for developing partners, providing technical assistance, investing in infrastructure, human capital. Mercosur, in theory, has elements of this, but as we discussed, it faces coordination challenges and lacks things like unified product recognition across members.
It's interesting that the current U.S. approach seems to be touching on some of this. The Biden administration's America's Partnership for Economic Prosperity.
Right. That initiative focuses on new investments, strengthening supply chains, decarbonization, and explicitly talks about inclusive trade and updating the social contract.
So an acknowledgement, perhaps, of the potential downsides of just pushing standard trade deals.
It seems that way. It acknowledges the need for a broader approach, looking beyond just tariff reduction.
And this all comes back to needing, well, less politics, more collaboration.
Absolutely. It really underscores the vital importance of nonpartisanship in tackling these issues. You need that to identify shared priorities, to enact policies that genuinely emphasize social inclusion, economic diversification, sustainable growth. Bringing diverse perspectives together leads to more holistic, robust policymaking and ultimately better long-term stability.
So looking at those three options and thinking about successful models, do the sources lean towards one approach in particular for Latin America?
They do make a fairly strong recommendation. Looking at the EU's relative success as a model, things like unified product recognition, successful programs like Erasmus Plus for student mobility, achieving a high level of inter-regional trade, about 67%.
Okay.
The recommendation is for Latin America to prioritize regional integration through an inclusive multilateral trade policy.
So the first option you mentioned, why that one specifically?
Because it allows for a kind of loose cooperation without demanding exclusivity. It promotes free trade among diverse subgroups within the region, but crucially, it allows for mechanisms to channel investment specifically towards disadvantaged populations or regions. It helps streamline regulations, achieve economies of scale, and directly counter that spaghetti bowl effect of overlapping, sometimes contradictory bilateral deals that exist now.
Okay, that makes sense. A more coordinated, inclusive regional approach.
Yeah.
Now, before we wrap up, is there anything else driving growth potential that we haven't touched on much?
Yes, absolutely. One final but incredibly powerful growth driver we can't overlook is travel and tourism.
Ah, yes. Huge for the region.
Massive. The sector contributed over $629 billion to Latin America's economy in 2023 alone.
Wow.
It supported something like 24.6 million jobs.
Wow. And the potential.
The potential is enormous. It's estimated it could add nearly another $260 billion and create almost 8 million new jobs over the next decade. But unlocking that requires the right policies, improving transport infrastructure, simplifying visa processes, better tourism marketing, definitely protecting biodiversity, which is a key asset, leveraging digital tech, investing in local communities, and ensuring safety and security measures are strong. It's a powerful engine, but it needs strategic management.
Okay, so to try and bring this all together then, it's clear Latin America is this region of just immense opportunity, but also deep complexity, isn't it? It's undergoing these significant economic shifts investors are noticing, but it's also grappling with these really deep-seated social challenges, inequality being a major one. And the path forward seems to evolve well, a mix of strategic investment, thoughtful, inclusive policymaking, and a real commitment to ensuring growth benefits everyone.
Exactly. And if you connect all this to the bigger picture, the whole narrative around Latin America feels like it's evolving, doesn't it? It's moving away from this perception of just, homogeneity and risk towards recognizing distinct, exciting opportunities, but also recognizing the urgent, absolutely undeniable need for integration that is both inclusive and sustainable.
So here's a final thought for you, our listener, to maybe mull over. As global trade patterns keep shifting, keep redefining what emerging markets even means, what unique role will Latin America's blend of abundant resources, its demonstrated resilience, and its ongoing social transformation actually play in shaping the global economy of tomorrow? And how can you continue to track these crucial, complex, and really fascinating developments?